Be Wealthy and Smart, episode 1216.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about why did the stock market drop so much yesterday, and is it time to buy? Because that's the question that people were asking. What happened to the market? Why was it down more than 1%? And was that a good dip to buy on? Well, as you know, we've been talking about the June correction that I expected, and this is part of that June correction. Yes, we had a dip and then a bounce, and now we're having a dip again. But when I look at a chart, we're way above the 50-day moving average and looking very overextended here. So I think we're going to go back to that 50-day moving average line and possibly even somewhat below. But that's a healthy pullback, a healthy correction, which you need after we've had the huge advance since the October lows. So that's very healthy. It's part of a normal market to digest some of those gains and for traders to take profits. And sometimes that profit taking is related to news. And the news that we got was that there was a better than expected jobs report, which showed the private sector jobs increased 497,000 in June, according to data from payroll processing firm ADP, which is the biggest monthly gain since July of 2022. June's increase was more than double the Dow Jones consensus estimate of 220,000 and far better than the downwardly revised 267,000 job addition seen in May. And that sent the 2-year Treasury yield to hit a 16-year high yesterday, which is what drove the stock market lower. All of that. Now, the ADP data is often considered unreliable and it's more volatile than other employment data. But today we will get the official June payrolls report. Economists are expecting 240,000 non-farm payrolls were added last month, slowing from 339,000 jobs added in May, according to Dow Jones. But now traders are expecting a hotter number for that employment data. And that might lead the Fed to resume its hikes after pausing in June. And right now, traders are pricing in approximately a 92% chance of a hike in the July central bank meeting later this month, according to the CME Group. So because that number came in more than double expectations, that really ratcheted up the fear that the Fed is going to have to get more aggressive. And that made interest rates move up quickly and spooked the stock market. On the other hand, job openings fell more than expected in May, according to a Labor Department report. And that data provides hope that the tight job market may be seeing at least some loosening. Jeffrey Roach, chief economist for LPL Financial, said the data leading up to Friday's big employment release are pointing to another healthy jobs report. Unless Friday's report is much weaker than expected, the Fed will not likely change its plans to increase rates during the next regularly scheduled meeting later this month. Well, we know that the Fed has 2 additional hikes planned. What we don't know is what comes after that. And if this jobs data comes in looking so strong, then the market is going to fear that more than 2 hikes are going to be needed to cool off the economy. And that is going to send interest rates higher, which is going to send stocks lower. Now this year, the mega cap stocks have been getting all of the attention because they've had such a boom from AI, artificial intelligence. So if we look at what's going on with the small cap stocks or the Russell 2000, we can see a little bit of a different picture. For the week, the small cap stocks and that index, the Russell 2000, is down 3% and headed for its worst weekly performance since March. Mark Hamrick, senior economic analyst at Bankrate, said the plight of the economy, including the job market, through the end of this year remains a question. If the inflation-fighting Fed feels compelled to raise interest rates further, as it has recently signaled, risks of economic contraction remain or even grow. Yeah, and that's the risk, is that the Fed can raise interest rates too much and thereby cause a recession. And that's maybe what's going to happen, because I've always said I see interest rates eventually coming down later this year, and it would make sense that if the Fed raises rates too much, that could tip the scales and put us into a recession, because it just stops everything in the economy so much. It stops housing completely. It stops business borrowing. It could stop new car sales. It could stop anything that depends on credit and borrowing in order to make sales. As I said, the yield on the 2-year Treasury hit a level it hasn't seen in 16 years, trading at 5.05% yesterday. That's the first time that the 2-year Treasury has traded above 5% since March. Now, the Fed usually skips a meeting in October, but odds that rates will stand a half a point higher by the November 1st meeting are now at about 40.1%, up from 31.6% odds on Wednesday. There's even odds of 8.4% that interest rates will rise 0.75 of a point by the end of the November meeting. So that was the cause of the dip yesterday. And no, I don't think it's time to buy yet. I think with this unsettling with interest rates, that means we have further down to come, more gains to digest, more profits to take by traders, and we're going to see this pullback continue until it gets scary again. And the bottom usually comes when there's maximum pessimism. So when things seem to be at their worst, and they can't possibly get any worse, they just sound like everything's going to continue to go to heck in a handbasket, that's usually where we're near the bottom. So keep a long-term perspective. This is something we have to get through to get us to the other side, but I do believe we are in a new bull market and we're going to recover from this. We just have to have this pullback and digest some of the spectacular gains that have been had since the bottom in October. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified as soon as new podcasts are available. And all of my podcasts are on my Wealth Mentoring Library on my website at lindapjones.com/podcasts. There you'll find a search bar where you can search for any topic you want to know more about for free. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.